Stocks slip after a firm opening as the street remains wary in a highly uncertain global environment. Financials and realty manage gains, while pharma, utilities and capital goods drag.
Reliance Industries beats its street expectations with profits growing 22% quarter on quarter, led by this oil to chemical segment. Outperformance analysts are also upbeat on the company, keeping its net debt in check.
And the Reserve Bank allows HDFC Bank more time to meet priority sector norms and allows HDFC Group to up its stake in its insurance arm, but doesn't offer any concession on the CRR or the SLR. The news fires up HDFC Life.
ICICI Bank delivers a record-breaking performance with the highest ever margins for the company, quarterly income growth, return on assets and return on equity as well. The stock, as a result of which, perks up. Good afternoon, hello and welcome. You're watching us here on Halftime Report. It's halfway through the trading session. I'm Manglam Malu, with me as always Sonia and Ekta. You know, we had thought on Friday that post-Friday, the results that will come in from Reliance and ICICI Bank will move the market out of its funk. But that wasn't the case to be. All of last 3 days, we moved about 3 points and now we're up around 2 points.
Oh, absolutely. That was the narrative at the start of trade, right? And look at the markets. Just doesn't oblige when you want it to, I guess. But let's see. For now, ICICI Bank is still a great set of numbers. I think the drag really is coming from a lot of the other heavyweights, whether it's ITC today, whether it's a lot of the technology names as well. But there's a long list of earnings coming through the course of the week, so plenty to talk about today.
Hi, Sonia. Yes, absolutely. For example, we have Bajaj Auto tomorrow, so that would be important to watch out for. But nonetheless, let's start with ICICI Bank, because that one has actually enthused the street in terms of what it reported. No negative surprises. This comes after HDFC Bank last week. So let's talk a little more about ICICI Bank in terms of its fourth quarter numbers. Abhishek is here with the fine print and what he made of it.
Well, Sandeep Bakshi has created history for ICICI Bank in Q4 FY23. So records continue to gather as a net interest margin of 4.9% is the highest that they have ever seen. The domestic net interest margin has crossed the 5% level, and the international net interest margin is also at 26 quarter high of more than 1%. So the NII growth is perhaps one of the best that you are seeing in last 8 to 10 years, given the fact that it's a growth of 40.2% YOY, which has aided the PAT or the earnings or the bottom line of the bank being the highest ever in terms of quarterly performance. So highest ever quarterly return ratios as well. The return on asset is at 2.39% and the return on equity is at 18.9%. Asset quality continues to improve. The gross NPA ratio has come down to 2.81% and net NPA ratio at about 0.48%. So the asset quality is one of the best that you are seeing in last 33 quarters or even more. Unsecured book is the highest in last 22 quarters. The proportion of that unsecured book in the overall loan mix is now at 19.4%, which continues to aid in net interest margin being on the higher side. On the flip side, the deposit growth, that's a bit worrisome. It's come in a little less than 11%, and going ahead, management has indicated that the net interest margin may not be sustainable at current levels, but 5% net interest margin on domestic business, even a small decline will go well with investors. PNL, both in terms of NII and PAT, it's a beat on our poll. Brokerages remain upbeat on the stock. They say that the ROE will increase to about 17 to 18% for the full year by FY25. So they raised their estimate by 3 to 9%, and they say that uptick in deposit mobilization will be a plus point given the fact that FY24 loan growth will be strong. Across brokerages, the target price ranges from as low as 1100 to as high as 1200 per share. Back to you.
All right, Abhishek, thanks a lot for that. So that's about ICICI Bank, the top gainer on the Nifty Bank today, up around 1.5%, and the top contributor out there as well. In fact, let's also listen in to what the MD and CEO Sandeep Bakshi had to say on the numbers in the company's earnings conference call.
Including non-fund based outstanding, the retail portfolio was 45.7% of the total portfolio. The business banking portfolio grew by 34.9% year-on-year and 7.8% sequentially. The SME portfolio grew by 19.2% year-on-year and 6.2% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic loan portfolio grew by 20.5% year-on-year and 5% sequentially. The overall loan portfolio grew by 18.7% year-on-year and 4.7% sequentially. Looking ahead, we see many opportunities to drive growth in the risk-calibrated core operating profits. We believe our focus on customer 360, extensive franchise and synergy and collaboration within the organization, backed by our digital offerings and process improvement and service delivery initiatives, will enable us to deliver customized solutions to customers in a seamless manner and grow market share across key segments. We will continue to make investments in technology, people, distribution, and building our brand.
Okay, that's Sandeep Bakshi, who has pretty much changed the fortunes of ICICI Bank ever since he came on board. And of course, the stock has been doing pretty well too, up almost 1.5%. Let's step into a quick break. But on the other side, we'll put our focus on the hospital space as the sector has seen a rise in M&A activity this season. More on that coming up. Well, as promised before the break, we're now going to talk about the hospital sector. Now, this sector has seen a rise in M&A activity this season. Ekta is standing by the big wall to tell us about the whole host of deals that have taken place in the sector. Ekta, over to you.
Thanks for that. Well, yes, the hospital sector is abuzz with deals, from Singapore PE fund Temasek becoming the majority stakeholders in Manipal hospitals after buying an additional 41% stake for around 16,400 crores, to smaller deals such as Fortis picking up a 350-bed hospital near Delhi for around 225 crores. Other deals in the offing could be Abhay Soy promoted Max Healthcare picking up TPG-run Care hospitals. An Economic Times report is pegging valuations for the deal at anywhere between 5,500 to 6,500 crores. Other deals in the offing include Manipal itself buying the hospital chain of Imami Group, AMRI, for around 2,400 crores and picking up Kerala-based private hospital chain KIMS for around 3,500 to 4,000 crores. Acquisitions are done for various reasons, from increasing the geographic presence to accessing pan-India multi-speciality bed capacities quickly. For example, Fortis, with the acquisition of Meteor Hospitals, will be propelling to become the second largest hospital with bed capacity in Gurugram. It will fulfill its strategic approach of expanding in the Delhi NCR geographic cluster. On the other hand, Manipal could surpass Apollo hospitals by increasing their bed capacity to over 10,000 beds in case the said acquisitions go through. And Max, which has over 3,400 bed capacity, will access 2,400 beds from care hospitals, helping it achieve targets of increasing its bed capacity by over 2x in the next 3 to 4 years. The common thread amongst all these acquisitions is cashing in on the structural growth drivers, hence many are ready to pay top dollar for these acquisitions. Valuations for the hospital space have risen as much as 8x in the past 5 years, with deals such as Manipal Temasek done at 10 times MCAP to sales, which is a premium of 5 to 6 times versus peers. These structural growth drivers include increased health awareness and insurance penetration post-COVID-19 and increased inflow from international patients as India positions itself as a medical tourism hub. All this will help aid the operations of the hospitals. For example, average occupancies in the hospital space are expected to go from the current range of 65 to 69% to over 75%. Average occupied bed rates could rise by around 10%. As far as medical tourism goes, it has risen 30% from 2014 to 2019, with currently many of the large hospital chains seeing business revert back to pre-COVID-19 levels. Estimates are the number of medical tourists could rise to 3 million by 2030. Lastly, why acquire? Today, building a hospital requires a capex of around 1 to 1.2 crores per bed over and above land acquisition costs and other costs, resulting in a time frame of up to 3 to 4 years to even come on stream. Acquisitions are cheaper and more cost-effective. Acquisitions, hospital owners and analysts say, is cash accretive from day one due to the immediate and fast without capital to invest and build. All this hence aiding cash management and possibly even justifying the valuations. In fact, we have with us Viren Shetty, who is the Executive Director and Group COO of Narayana Health, and we have with us Dr. Balal of Manipal Hospitals joining in now to discuss all of the M&A activity. Gentlemen, welcome to this discussion. Dr. Balal, I'm going to start this discussion with you, considering that Manipal has really been in the news in the past couple of weeks. Give us the reason why Temasek was so interested in Manipal. What was the reason for the acquisition and the kind of premium that you all also got?
Good afternoon, Ekta. Thank you for having me here. Good afternoon, Viren. I think we are in a very exciting period. M&A seems to be the flavor of the season. Temasek is not new to us. They have been our shareholders for quite some time. They have been on the board too for the last 6 or 7 years. And they have seen the practice of medicine grow significantly in the Manipal sector. And they are very, very comfortable with what Manipal is. And I'm sure that's one of the reasons that they've invested in healthcare. In addition to the belief that healthcare is sort of going to surge ahead, and the setback that was there during COVID, I think we have overcome that. And we are looking forward to a very healthy growth in the future. I think our familiarity, our culture, and the future growth of healthcare is what Temasek saw in us.
Okay.
Right.
Sorry, Viren Shetty is also with us. He's the Group CEO of Narayana Health. Viren, do you see a lot more deals in the pipeline now? I mean, there's clearly a lot of interest in this space. And as Ekta was pointing out, perhaps valuations are also looking good. Assets are there for the asking. What is your own view on what the size and scope of these deals could be in future as well?
There are a lot more deals that will come about. And as you said, the valuations are looking good for the seller. For the buyers, of course, these things tend to be quite expensive. But I guess institutions like KKR, Temasek, Carlyle have all done their homework, and they figured that there's a lot of opportunity to make back the returns from how much they're investing in making these expensive acquisitions.
Right. Recently I put out a piece comparing hotels with hospitals in the sense that both their businesses are similar, where you have to obviously put up a facility and thereafter you earn off occupancies, with the obvious difference being that hotels is cyclical, whereas hospitals is a lot more structural. Dr. Balal, I just wanted to understand your thoughts on, have we moved up in this structure of return ratios and businesses for hospitals, from a business standpoint over the next 5 to 6 years?
I agree with you. I think there's a lot of advantages of acquiring the chains of hospitals rather than greenfield projects, which take a very long time to start making money. So there's a significant advantage of acquiring large-scale hospitals. And what we have seen is a steady growth of at least 10 to 15%. And we should actually look at the growth from 2019 onwards, because 2020, 21, 22 were retarded growths due to the COVID pandemic. But certainly, all of us are growing at a healthy level, and we do believe our occupancies will go from 60 to 65% to about 70 to 75% in the future. And I think acquiring hospitals is probably the better way of doing business. However, we are also looking at many greenfield projects, mostly in the places that we are already well established.
Okay. Viren, I just wanted to understand the premiums. For example, the Manipal-Temasek deal was done at some of the heftiest premiums that we've seen in the hospital space, at around 10 times MCAP to sales. And if you compare it to its peers, the peers are still at anywhere between 4 to 6 times. Based on this expensive deal that's taken place, do you expect the valuations to become more expensive for further deals going forward?
Well, to be fair, that Manipal is a phenomenal hospital group, and it is a marquee brand in their key hospitals. So it may not be shared by hospitals that aren't of the same caliber, but for hospitals that are, I would guess it would drive up the valuations, yes.
Okay. Just on that point, Viren, are there any distressed assets within the hospital space which are for easy pickings at this point? Because one of the trends that took place post COVID-19 was that the stronger players managed to emerge, and maybe the smaller hospital companies couldn't cope. So is that a type of trend which is also taking place?
Well, hospitals have been distressed even before COVID-19, and for multiple reasons. But the reasons these hospitals end up being distressed does not go away just because you get a much larger parent to take it over. Sometimes it could be location, sometimes it could be just spending too much on a building, sometimes it could be all kinds of regulatory issues. None of that goes away. And anyone that's looking to make a cheap acquisition of a distressed asset will end up inheriting a lot of the headache that came with the reason that hospital was distressed. So it's not always cheaper in that sense, or easier. It's just a question of how much time and money you're willing to commit in the pursuit of growing a large network full of beds.
I want to go to Dr. Balal, but before that, Viren, at the end of the day, for someone who's watching our show, right, what matters is in the hospital space, if occupancies are rising, if medical tourism is back in a big way. And I'm sure, the M&A guys, the PE guys who are investing are expecting these trends to improve, and hence the future looks good as well. But you tell us, what are the numbers right now? Have occupancy levels risen? Has medical tourism come back in a big way? And what do you see as the way forward, say, over the next 12 to 18 months?
It's always hard to project how things work out in this sector. The fact is, there was a huge lag during the COVID time, and people were not getting elective surgeries done, which has bounced back. And with the increase in general awareness about your healthcare, so a lot of people have realized that they need to get checkups done, they need to start taking care of their health more, and that ends up with them being consumers, active consumers of healthcare. But still, there is tremendous room to grow, because as a country and as a people, Indians are the least likely to seek medication, the least likely to access healthcare, have some of the worst health outcomes for people of the similar genetic disposition. And it just means that there is a large market for people who need to access healthcare that there is their right to. So regardless of the international expansion, regardless of how you look at it, people do need more healthcare, and hospitals are here to provide that so that they can live long, healthy and productive lives.
Right. People do need more healthcare. We've learned that during the pandemic more than ever before. But Dr. Balal, just wanted to understand a couple of things from you. One is that is there enough supply of quality talent in the hospitals business? While it's easy for everyone to go ahead, acquire companies, pay top dollar, acquire or build facilities so that there is enough infrastructure, but the soft skills of surgeons and good quality doctors, is there enough in the supply pipeline for the same? And secondly, where exactly does your deal with Imami stand at right now with regards to AMRI? Is everything done?
To answer your first question, Bet, I fully agree with you. I think hospitals are not just brick and mortar buildings and CT scans and MRI, PET scans, etc. It's really the human resources that make a hospital what it is. In the cities, it's certainly not a big problem of getting talent, because most of the qualified doctors, specialists tend to sort of gravitate towards the cities. And by and large, in the cities, we haven't had much of a problem. And so far, most of our hospitals have been in the tier 1 cities, except our teaching hospitals, where it's a different ballgame altogether. So far, we haven't had too much of a problem acquiring talent because of where we are located. And also, most of them are about 250 to 300 bedded tertiary quaternary care hospitals. But it may be a problem in the future, because what we see is more than shortage of doctors, it's an inequitable distribution of talent. You go to a place 100 miles away from Bangalore, it may be very difficult to get a good surgeon, certainly very difficult to get a good transplant surgeon or a cardiac surgeon. So I think so far the problem has been manageable. And also we have the synergy of having a large number of hospitals, at least in some of our locations like Bangalore. The second is, you asked me about Imami. I would not comment on anything more, saying that we're in the advanced stages of negotiation, and hopefully you will know very soon.
Okay, well, that is definitely some of the statistics that we do need to improve, the doctor-patient ratio, the nurse-patient ratio across India. But I'm going to request Dr. Bilal as well as Viren to stay on. We need to take a short break, but we'll be back with more questions on M&A activity in the hospital space. Stay tuned. Welcome back. We still have with us Viren Shetty, who's the Executive Director and Group COO of Narayana Health, and Dr. Bilal of Manipal Hospitals joining in to discuss the hospital space in India and the kind of M&A we've seen recently. Viren, one of the trends which has also stood out within the hospital space is the interest from PEs within hospitals. We've seen deals such as Manipal Temasek, TPG Care, KKR Max, just to name a few, even the likes of HCG, CVC Capital. What happens when a PE firm buys into a hospital company? Because eventually they do want to exit with higher returns. So how does that affect the operations? Are we going to see more deals coming in from the PE front when it comes to hospitals?
See, PE funds chase yield. more than anything else, they invest in sectors where they see some inefficiencies and underperformance, and they're able to increase the yield of the assets that they acquire, not just in healthcare, in most industries across the world. And the Indian private healthcare industry does owe a great deal of gratitude to a lot of the PE funds who first put us on this journey of become professionalized institutions. Because I'll just speak from our own experience. Prior to us bringing in professional investors, we didn't even have a proper accounting system. We had no idea of how much material was coming back and forth. We had no idea of how to generate bills on time, how to collect them. And so that discipline of being financially rigorous is something that PE funds bring to every hospital that they acquire, and that is of tremendous value. But of course, beyond the point, you're looking at a sense of maybe diminishing returns, in which case if you are buying in to a healthcare group at a very high valuation and you're looking to 2x, 3x, or 10x that investment, it would mean that you would have to be a little more aggressive in the way in which you run your operations. And that is fine to an extent, because a lot of aggression does come from how you expand, how you grow, how you add beds, and are able to project a view of the future that could square with the reality of a market like India, which is growing very quickly. So I would say that it affects the operations in that it does cause hospitals to be more cost efficient, to be able to offer more services to charge, and to be more aggressive in their growth.
Dr. Balal, of course, on one hand, when PE investors get into a certain type of investment, they're looking at, tightening the ship or cost effectiveness, etc. But the other thing is structural growth drivers, right? And Ekta was pointing out a couple of growth drivers that the space is seeing, whether it's higher insurance penetration, pickup in medical tourism, which was missing for a very long time. But you tell us, going forward over the next couple of years, what do you see as the main growth driver for the hospital's business?
I do agree with you. I think private equity has contributed a lot to growth of the healthcare sector. We have particularly been with the private equity for quite some time. And as Viren mentioned, I think there is certainly a much better management, a tighter control of what's happening, and a more closer look of how the hospital is administered and how it grows. Everyone looks for return on the investment. So I think these are all needed for us to grow. The future, as I see, is one, certainly I think we'll have more healthcare awareness, hopefully more insurance penetration of bringing in more patients who require healthcare, and certainly more of medical value tourism. And hopefully at some point, there will be a percolation down of significant healthcare institutions to the tier 2 and tier 3 cities, which is bound to happen. Just like how it has happened with specialists, once a city like Bangalore is sort of saturated, we see a lot of specialists, nephrologists, cardiologists, so on and so forth, moving into other towns where there is growth. So I think this will be the pattern for the future. But I am quite optimistic that healthcare is here to grow, and it will grow significantly in the next few years. And it needs to grow in a large country like ours. And soon, hopefully, we'll be the healthcare givers for the world, like what the Western world was in the past.
Point well taken, Dr. Balal. Viren, I just wanted to probe a little further on this. While healthcare needs to grow, are there any trends that you're seeing? A certain kind of hospital is seeing a faster growth, or is there a latent need for something which you believe can be a growth driver in the future? I mean, we are all talking about specialty hospitals, we're all talking about general care hospitals, but anything specific that you see as maximum growth potential?
See, there is demand for healthcare that will continue unabated. But the problem that happens is that there are vast segments of the population that are simply not able to afford the sort of treatments that are being offered. And so when we look at our expansion, there is a need for tier 1 cities. There is a different sort of hospital that you create for tier 2, tier 3, and even in the tier 1 cities, there are different payer groups that you're going after. More than growth of people who have insurance, or people who are flying in from abroad to get very high-end treatment done here, the greatest need is for the middle class, the lower middle class, and the poor farmers of this country, for whom there still needs to be a lot more cost rationalization. There still needs to be a lot more efficiencies brought in from the private sector to be able to service that. So we see that as some of the growth drivers for our group, which we call and has been termed as the missing middle. And so they need insurance, they need healthcare, they need primary care, they need preventative care, they need lab tests, all at a price that is much lower than what is being provided, even in our group today. And so a lot of the effort that we're putting in is towards servicing that need. Now, it does not necessarily mean that we need to add more beds to achieve that we need to add too much more expensive infrastructure to achieve that. There is a lot of soft efforts that we need to do on our processes, on the way in which we discharge patients, process them, and the amount of throughput we can put in that can help reduce our cost even further and take care of those patients. So we see a lot of growth coming in from India.
I'm just going to interrupt and ask you, what's your plan when it comes to M&A? Are you looking to be acquired? Are you looking to acquire? Because Narayana has been relatively, I'm saying relatively, quiet as compared to the peers when it comes to M&A.
Yeah. See, all of this costs money. And who pays for it at the end of the day? It's not Temasek or KKR. They're just lending money to the hospital group to do its expansion and so on. In the end, these costs are borne by the patient. And unless the things that we spend money on improve the healthcare outcomes for them, reduce the cost, allow us to do more with less, it doesn't make sense for us to spend huge amounts of money towards M&A. Now, it's not that we don't do M&A, we do. It's a lot smaller, it's a lot more gradual. But the things that we are pursuing are the cost reduction that is desperately required in this sector.
Okay, cost reduction is the need of the hour in this sector. Got that. Viren and Dr. Balal, pleasure speaking with you to understand what's happening in the business and what the way forward could look like. Appreciate your thoughts on CNBC-TV18. Thanks a lot for joining us.
Very much.
Thank you.
All right, let's do one thing. It's a very quiet market, so let's slip into a short break. On the other side of the break, Kishore Roongta, who's the Chairman and Managing Director at FACT, will join in for an outlook on their business. Stay with us. Hello and welcome to this special broadcast of Medicine Box. Today we put focus on the hospital sector. This sector has seen a rise in M&A activity this season. Ekta's here standing by the big wall to take us through the latest deals that took place in the hospital sector and the rationale for the surge in valuations. Ekta.
All right, time for a short break, but we'll continue this conversation with our guests on the other side. Stay tuned. That's all the time that we have on this edition of Medicine Box. Thanks very much for watching.
Welcome back to Halftime Report. In the last 20 years, India witnessed double-digit monsoon deficit 3 times, and Centrum in a recent note indicates that India's monsoon patterns are always different. So to decode the impact of extreme weather on the fertilizer sector, we're joined by Kishore Roongta, the Chairman and Managing Director at FACT. Mr. Roongta, good morning and thanks a lot for joining in. Before I ask you about your own business, there's lots happening as far as the monsoon situation is concerned. There's a possibility of an El Nino. There's also unseasonal rains which has impacted the crop quite a bit. Your own business has, of course, had a decent trajectory. But given that we are staring at perhaps what could be a volatile monsoon season, how do you think all of that would impact your business? How has extreme weather hit your business in the past?
Yes, fine. Good morning. I would like to tell you one thing, that if you see the IMD predictions, the monsoon is predicted at 96%, so which is more or less normal. And if you see the prediction for the southwest regions, it is being informed that it is going to be normal. Right now, what heat waves we are going through, definitely it has got impact. But anyway, the month of March, April is the lean period for all the fertilizer companies. So we don't sell much of the product in these 2 months. But from May onwards, from 20th of May onwards, we feel the demand will be as normal as it was there in the last year. So we don't find any difficulty in selling our product for the company and for the industry as a whole.
So, Mr. Rungta, can you quantify that? Because I'm sure you must be getting the trends intact because sales are going to pick up May onwards. How does it compare, say, to last year? And what are you predicting for the entire season?
Yes, this is a Kharif season going on. Basically, the season will start from 15th of May to September till 30th September. And if you see the last 2 years, the total consumption was 305 lakhs metric ton of various grade of fertilizer. So we are anticipating that in this Kharif also, the total requirement will be 305 lakhs metric tons. And in the Rabi season, which will start from October to March 2024, that will be 320 lakhs metric tons. So it will remain more or less intact.
All right. Mr. Rungta, I just wanted to know your thoughts on the nano fertilizer segment. I mean, we had the fertilizer secretary speak about that. Are you looking at manufacturing nano fertilizers as well? Have you announced any sort of, investment behind this?
Nano fertilizer, right now only IFCO is making. We have signed an MOU with them that we are going to market the nano fertilizer in the southern India. So that is the only understanding we had done with the IFCO. So right now we will be only selling nano urea, which is being produced by the IFCO. We are not going to manufacture nano urea in our plant.
Okay. So you're not going to, so there's no additional investment that you're looking at doing for the nano fertilizer segment?
No, we are not going to add nano fertilizer production in our basket. Okay. But of course, we are going for capacity expansion. We will produce another 5 lakhs metric. That capex is going on.
So can you tell us about the capacity expansion? What are the plans? What will the capacity look like, say, 1 year down the line? And how much would you be investing? Will it be largely from internal accruals? Are you looking to, take on any debt?
Yes, here it is like that. We are going to spend almost 700 crore rupees for the capacity expansion. Our projects are going on, and we are going to add this another 5 lakhs metric ton of fertilizer in the month of, by end of 2024. So with this, my total production capacity will be 15 lakhs metric ton. Right now, we are producing 10 lakhs metric tons. We'll add another 5 lakhs metric tons.
Okay. The prices of natural gas have been revised. For example, from April 8th to the 30th, it has been set around $7.9 per MMBTU. What is the impact on the business?
Yes, see, this impact, what you are talking, that is basically for the pool gas price, and that is being supplied only to the urea plants. We are not manufacturing urea. We are manufacturing complex fertilizer. So the impact of this will not come to FACT at all.
All right.
You had sold almost 500 acres of land in FY20. That's 482 acres. Wanted to know if there is any more non-core land that you have which you wish to sell or monetize when that happens. And secondly, the subsidy that's outstanding from the government under the DBT regime.
Yes, you said correctly. Whatever we have sold prior to the previous year, 1920 and 2021, with that money we are going to add to the capacity expansion. And that is why we are not borrowing any money from the banks or institutions for the capex project. And right now, whatever surplus land was there, that we have already given to the government of Kerala, and there is no further surplus land available to us. Whatever tidbits lands are there, that will be used only for our expansion plan. So we are not going to do further monetization of the land. That is number one. And number two, with respect to subsidy, the government is going to announce the subsidy very soon. And till March, government has already cleared all the subsidy dues to FACT. So we don't have much of the outstanding now.
Just a follow-up on that, you said that gas price cuts will not impact you, but how is it that it will not impact you? Because you use it as a raw material, right?
That's correct. But see, what you are talking is a pool gas price. Right now, what we are buying is from the market. We have made a long-term contract with the IOCL, and we have tied up with the Gorgon gas. So whatever will be the Gorgon gas, that will be given to the FACT, and this tie-up is for the 5 year with IOCL. So right now, the natural gas price, what you are talking, that will not have any impact on FACT.
So, but this tie-up that you've had, is it at a fixed price, this tie-up that you've had with IOC, and what price is it?
It's not an international benchmark price. It is with the Gorgon price. So whenever price goes up and down, it will have impact on us. Right now, price is in the decreasing trend.
Okay, just a quick word with regards to your input costs in any way, sir, because there were, there were reports doing the rounds that in the month of Feb, there was a hike by complex fertilizer manufacturers because of input costs rising. Where do things stand? Have you taken a price hike? Are you covered in terms of the incremental input cost price rise that we've seen?
Yeah, you said correctly. Last year, the price has shot up by almost 200-300%. But the government subsidy, if you see, it was increased from 1.75 lakhs crore to 2.25 lakhs crore. So the government has insulated. We have not increased the price at that point of time because we were getting additional subsidy from the government of India. So that is where we did not increase the price in last year. We kept the control on the MRP.
Okay, all right. Sir, thanks a lot for joining in. We've run out of time, but thanks for giving us, an update on the business and the way forward as well. Let's slip into a quick break on that note. On the other side, we'll get you more markets, more stock-specific action. The market is very quiet, but the Bank Nifty is doing quite well, 300 points in the green. So more on that coming up. Viren and Dr. Balal, thank you so much for joining us and giving us an update on the hospital space and what the way forward could look like. Appreciate your thoughts. That's all we have in this edition of Medicine Box. Thanks for watching.
Welcome back. We're picking some pace for the market right now, up around 40 points on the Nifty, but still have been in a bit of a range today. Though the good part is that the range that we've seen today on the index is a little higher than the range that we saw for the last 3 days. So the last 3 days, every time the Nifty went closer to that 17,700 mark, we saw some supply. Today it went ahead and crossed that, and at lower levels as well. We went all the way up to 17,580, 17,550 to see some support, but today we found support at 17,620 itself. The Nifty Bank is the key contributor on the way up. In fact, as we speak, the Nifty Bank is up almost 1%, led higher by ICICI Bank, understandably because of its results, and post that we're seeing some support coming in from SBI and Axis Bank as well. Importantly, watch out for the Nifty as it approaches that 17,700 mark, because this is the expiry week and we've seen a fair amount of writing at the 17,700 call and the 17,700 put. So those who've written the 17,700 call expect the Nifty not to cross that 17,750 mark, whereas those who've written the 17,600 put don't expect the Nifty to fall below 17,550 itself. And if the markets were to be in a range, it would be godsend for those who are writing the 17,650 straddle, which is a call and a put together, almost 130 odd rupees, playing again for a range of 17,570 to 17,830 itself. And that ties in with the technicals as well. We have the 200-day moving average of the Nifty at 17,605, which is a strong support. But on the way up, the 100-day moving average may act as a bit of a resistance. So that's about the technical and the F&O setup at midday. What we'll do is take a short break and also a break from the equity markets. Manisha Gupta joins in with all things commodities on the other side.